Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Okay, we're going to continue on with our Tesla end of the year valuation based on what Elon has told us recently in the Q2 shareholders meeting and Q2 earnings call. In the previous video, we managed to break up all the factories and models and assigned an estimate of how many vehicles were produced. And it is production that's more important rather than deliveries. Deliveries generally factor in demand, but Tesla is not demand constrained, it's production constrained. As a result, Tesla can only grow as fast as it can produce. We'll continue building the spreadsheet in order to work out the potential earnings. It's also available for download on Patreon. Anyway, the next task to calculate is all the ASPs. The way I do this is a little bit hit or miss by finding previous instances of the website and aligning them with all the delivery dates that would be December, i.e. end of the year. Now, last quarter, we started to notice some of those price increases finally creeping in. However, this was absorbed by the additional costs with Shanghai downtime, and then, of course, the cash furnaces. Anyway, that was the average of Q2. We're now talking about the end of Q4, 7.5 months later. In other words, I would hope that all these price rises are going to be in effect, except for the latest Model Y price increase. Alright, I've gone through all the models from all locations and compiled a list of what I think should be a close approximate of all their ASPs. They do seem a lot higher this time around, but that is what we should expect. Some of these prices really have risen, like the long-range Model S. Anyway, we would hope that it's all added into the margin. That does give us enough information to calculate the auto revenue for just the vehicle sales, which comes to over $33 billion. To give you an idea, Q1 2022 was around $15 billion. We're not even a year later and already at double revenue. I repeat, in this scenario, Tesla would have doubled their revenue in under a year. This also gives us an average selling price of $55,000, and we're taking into account the current exchange rates. We can add in some FSD. As usual, it still won't contribute much to revenue. Obviously, this side of the business still has tremendous potential, but right now, it's not even producing $1 billion a quarter. Perhaps though, when and if Elon announces FSD is complete or safer than an average human driver, this income could almost double, as Tesla might be able to claim 100% of it, whereas currently they're only realizing 60%. The price of FSD will also increase too. On top of that, Tesla may also be able to release the FSD deferred revenue possibly sometime in Q4. Alright, onto margins. Elon says he is seeing prices coming down and inflation potentially coming down, particularly towards the end of the year. And he's on the front line, seeing it all a lot closer than most of the data we get compared to CPI, which is a lagging indicator. But macros are also impossible to predict. We also saw a drop from 33% margin to 28% margin from Q1 to Q2. Bear in mind, when we calculate these new margins, it will be without the regulatory credits, which in the past has actually added to margins quite a bit, as they are 100% profit. You see, when Tesla raised their prices by 10%, it will go to gross profit, assuming no additional costs. So if a car was at 30% margin before, it would now be at 36%. That is a massive increase in profit. In Q1, we hit 33% margin, but we had a massive regulatory credit. When you remove that, then Q1 had 30% margin average. Anyway, Fremont prices are up across the board, about 10% or so since Q2. The majority of that will go to profit margins. I know the margins look high in the mid-30s, but look how much Tesla have raised their prices. That's what the numbers are telling me. As for Shanghai, well, remember when we calculated how the cost per vehicle decreases as output increases? Well, these line upgrades could have increased Shanghai production well over 40%, and Shanghai margins were pretty good already. I also suspect that even Shanghai battery cell costs may have reduced with the new CATL factory nearby, using more efficient processes and much closer saving in delivery costs. Now for Berlin, not quite as easy, but in the Q2 earnings report, we were told that Giga Berlin had reached a positive gross margin, yet while only doing over 1,000 vehicles a week. In this scenario, we are at 5,000 a week, as that is what Elon said he was confident he could achieve. And we're going for more of a best case scenario valuation here, in case you couldn't tell, at least to start with. So if we assume the first 1,000 vehicles covers the additional expense, then the remaining are down to cost of goods sold. Remember, we do have these new efficient factories using a rear casting for now and many other reductions in cost, while also raising retail prices. They'd be running about the same speed as Fremont, and this is not meant to be for almost 4 more months we're predicting, of which a lot can happen in that time, especially with Tesla. I want to put a 40% margin on the 4,000 additional vehicles after break-even. That would reduce the margin to overall 32%. Alright, Berlin, Austin at 32% margin at volume production. That doesn't sound too unrealistic. However, if you think this is low, then I can understand. It may very well be higher. Remember though, 65,000 units a quarter run rate, that is higher than Fremont's Model Y. So the margins should be higher than Fremont anyway. And you have to remember, Tesla raised these prices a lot, mainly due to demand getting out of control. These are the numbers I'm getting. Alright, so the total for all the vehicles produced comes to an average margin of 34%, compared to 30% from Q1. So assuming costs have not risen dramatically, I think these are okay. Well, now we have margins and revenue, it's not too difficult to calculate the gross profit. It comes in at nearly $12 billion. In fact, if we had some regulatory credits in there too, it does come to $12 billion. $12 billion for the equivalent of a quarter, or very nearly $50 billion annualized. These numbers are certainly getting bigger. I think even Wall Street would sit up and take notice of these. As for energy and services, well, services should have increased a bit, especially with Tesla getting back to these ex-lease vehicles, that I have a feeling Tesla may even be selling them for more now than they sold for 3 years ago. Seriously, what does this say about the product? If it is worth that much more after being used for 3 years with all that additional mileage, that is what demand does. Either way, energy and services do not contribute particularly much and will have very little impact on this model anyway. Alright, on to operating income. Well, I hope you're sitting down for this. It is just over $10 billion. Over 4 times what it was in Q2, and still 3 times what it was in Q1. From not even a year ago, Tesla have tripled their operating income. This is economies of scale starting to come in. Now, the tax rate will start to get a bit higher the more profit Tesla make. And I mean the actual percentage, because the profits will start to get so much bigger over time relative to any depreciation or amortization. Remember, Texas is likely to make more than 10 times profit a year than it cost to build. The profits become so big that capex starts to look minimal. So the downside of that is there is less to claim against tax. But hey, who's complaining when earnings end up coming in at $9 billion? Yes, that's our number we wanted, $9 billion, or $36 billion if you wanted to annualize it. I've also estimated that the GAAP EPS would be at $7.77 for those of you who like to use that as a metric, and the non-GAAP at $8.09. Wow, over $8 EPS. That's pretty good. We're talking about Tesla hitting this by the end of the year. That time will come quickly. That is so much profit. Enough to build 4 or 5 Giga Austins every single quarter. And this is before Austin is even cranking. This company is going to generate so much cash so quickly it won't have time to spend it. And if inflation is a concern, it means the cash is losing value. Also, if the stock is expected to keep climbing, and the insiders likely know to what extent better than anyone, then they'll be the ones who decide on a share buyback. I think our margins are fairly accurate. I think the average selling prices track well. The production rate was what we went off from the earnings call and the shareholder meeting. OPEX doesn't have much reason to increase by a lot. In fact, there are reasons for it to decrease due to layoffs and likely lower costs, with the headquarters based in Austin instead of California. But in reality, this run rate is inevitable one day. If not the end of the year, then likely sometime in Q1. So even if you think I got your hopes up, then it wasn't the numbers themselves that I got your hopes up on, but perhaps the date. Perhaps this run rate won't occur for even 2 or 3 more months later. The point is, it will occur, and those margins and ASPs are what they are. At the time of this video, the market cap for Tesla is $922 billion. That would equate to a P/E ratio of 25 on annualized earnings at that rate. Now, I don't give financial advice, but in my opinion, that does feel low to me, given there is so much more potential still to come. I can't even imagine what a forward P/E ratio might look for the whole year of 2023. This model actually made me so bullish, I ended up buying an option for January 2023. I'm not at all suggesting that you do as well, just letting you know that I put my money where my mouth is, although I did catch it on the dip. Thanks, Elon. Alright, so far so good. But how much is Tesla worth when they are generating that much income? Well, that's what we need to work out next. And don't forget, this spreadsheet is available for download on Patreon if you want to play around with it too. And let me know what results you get. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.